In private markets, we're really harvesting an illiquidity premium. So one of the things that we see consistently today is that investors, we think, are overpaying for liquidity or perceived liquidity. And as a result, we are able to charge substantially more by participating in the private credit markets. Few people want to participate there, so we can charge a premium. Put that in perspective, we might get LIBOR plus 600 basis points in a private credit loan. Typically, syndicated loan that's going to be traded in the public markets, it's going to be between 350 basis points and 450 basis points. So nice incremental spread there. In the traded markets, some of the places that we see opportunity are probably really the loan market first. The loan market has benefited over the last several years from a story that was told to the individual investor in the United States that the loan market would be an income growth product. Because the Fed was expected to regularly raise rates, you could buy it a few years ago, maybe you get a 5% return, and as the Fed raised rates and you had a floating rate product, your return would go up to 7.5 or 8%. Fast forward to January of this year, Powell completely reverses course, ends quantitative tightening, stops hiking rates, starts cutting rates, and that story completely broke down. So as the retail investor has left loans, we've seen some pretty significant opportunities develop in the loan market where there just wasn't sufficient demand. A bank brought a new loan to the market and just found really anemic demand, and as a result, sold at deeply discounted levels. So we participated in a couple of those. Also in the traded markets, on the bond side, we see incredible dispersion between performance at the high quality end versus the low quality end. So if you're rated BB, everybody wants to own a BB bond. Those have just run all year long. If you're rated CCC, that's complex. It's hard to understand. You have to roll up your sleeves and really understand what's going on with the company. Nobody wants to own those. Prices on those bonds have actually gone down this year. So those are some of the places we're seeing opportunity. We absolutely have to think about it. A lot of what we do is floating rate. So everything we do in private credit is typically a floating rate loan. Everything that we do in the loan market is typically floating rate. It's only really in the high yield market that we're exposed to a lot of fixed rate risk. We have to think about it because as people have reached for duration this year, as they've wanted exposure to fixed rate products, there's been a flood of money into high yield and a flood of money out of loans. So we have to think about it because that affects prices of the loans and bonds that we're investing in. But ultimately, if we're getting an attractive spread, we feel like we can get sufficient return by investing in a floating rate product. And we would rather do that than take a lot of interest rate risk, where if rates revert to where they were just at the start of this year, you could see really substantial losses.